want to talk a little bit about bubbles, actually, a point that you brought up. So as Americans, in addition to worrying about our caloric consumption and BMI index, it appears as if we now have to worry about fat tails as well. It's a phrase coined by Taleb. Essentially what that is a high frequency of occurrences that should be categorized as outliers, higher frequency of occurrence than would be predicted by a normal distribution. So large outlier events that really aren't such outlier events. And that really strikes at what I think is part of almost every single quant process I'm aware of, and that's the risk control. And I wonder if we could just get a quick discussion going on how you think about fat tails, outlier events, as it relates to risk control within your process. Janet, since you started with bubbles, maybe we'll start with you on this.
Well, we really look to bake the risk process in right from the beginning, both in terms of understanding what sorts of exposures we have in the portfolio and limiting upfront overexposure to certain types of factors or certain types of risk exposures, and distinguishing between trades we really want to make because we have an alpha call on that versus trades that were just end up in your portfolio without a real expectation to be compensated. So we like to start right from there. We do a lot of work around optimization and putting those sorts of triggers and floors into our portfolio, but we don't do anything that's high frequency. We don't have a way that we're going to take trades just off the table in response to a market move that happens over 5 minutes. We take a longer perspective on things, but at the same time, we believe that you could give up a lot of return if you look to protect yourself from an event that when you look at the information even on a monthly or quarterly basis as opposed to a daily basis, then your exposures start to look very differently. Right now, a lot of the things that people are very afraid of, and we are still, I think, very much in that fear cycle, other people are very happy to take the other side of that trade, and they will charge you a lot of money to give you that insurance. And I don't think that that's necessarily a good place to be if you're an investor, is paying those high prices for that insurance.
Kevin?
Yeah, so in terms of the Sortina ratio, just to get into that a little more, I spoke several years ago at a hedge fund conference, and the idea was to sort of build a successful hedge fund. So I thought I'd see if I could come up with a model to explain a successful hedge fund. So I looked at a bunch of different metrics to see that there's annualized return, the Sharpe, the this, the that, and actually out of 20 different metrics, the Sortina ratio was the one that best explained assets under management. And so what's going on there is you've got your return minus the minimally accepted return. In the long-only world, we've converted that to return minus benchmark. So it's your alpha if you want to think about it in long-only space. And then the denominator is, instead of the semivariance of negative returns, it's the semivariance of those returns where you've underperformed the benchmark. So I think it's probably the best thing that captures what investors want, which is a decent return or a decent outperformance with minimal negative returns or minimal underperformance in the long-only world. So I think it's a simple ratio, but it actually captures a huge amount of behavioral finance theory. In terms of bubbles, so I think I agree with Janet. I think there's lots of bubbles. I even think there's sort of a roaming bubble that's always out there. It shows up. Sometimes it becomes bigger than others. It seems to show up every 12 to 24 months. Sometimes they're huge bubbles. Right now, I think there's a bubble in U.S. Treasuries because of our national debt is so high. And I actually have a national debt clock app on my phone, and I noticed that since this morning's first cup of coffee, we've added $1 billion to our national debt, and the day's not over yet. So, I mean, I don't think that's sustainable. People are beating up on Ireland for their increase in debt to GDP, and that has now matched where the U.S. is. So, I mean, I think there's a bubble there, and I think we should be aware of that. And I like Janet's comments. Yeah, I think there's always a bubble, and sometimes they're bigger than others.
I think the hard part about bubbles is they're really easy to identify after the fact and really hard to identify while you're in them. Sure, it seems really obvious now that the internet, was a bubble. It really wasn't quite so obvious at the time. And what's even worse is if you thought it was a bubble at the time and you bet against it, that really didn't work out so well for a lot of people for a very long period of time. I mean, really, really respected firms out there went bankrupt. They lost all their assets. You were told that, you were just an old fogey. Like, you didn't get it that eyeballs was the way you were supposed to be doing, all your valuation models. And another way to think about it is like, we've done some work on trying to predict companies that are frauds. And we were really good at predicting some of these companies that were frauds. The problem is that you lost a lot of money, even though if you could identify them before the fact, because the fraud took a while to develop. And for everyone else to realize that this was a fraud, and while people didn't realize they were a fraud, those stocks were going up a lot. And so being early into this can really be detrimental to your wealth. You need to kind of actually be there and discover it exactly at the same, like a day, or some small period of time before everyone else develops it and get out first. And timing bubbles and timing frauds is a lot more difficult to do. And so I'm just skeptical on timing models in general on this. And so it's not really clear to me what you do about bubbles in this. And there's something to be said about going with the herd. You really kind of end up, unfortunately, looking a little bit better in this.
So you might be able to be too smart, right?
Yeah, I mean, I think the markets are, you can be too smart for your own good. I mean, what we really need in a funny way is just an optimal amount of irrationality in the market. And if the markets are really just super too much irrational, and you're rational, that's a bad place to be.
It's interesting. In the past week, actually, we were doing some work on fact tails, and one of the things we did was look at the S&P 500. And one of the issues with fat tails is it's dependent on the time horizon you're looking at. I mean, if you look at annual returns for the S&P since 1926, it's actually fairly normally distributed. Like if you overlaid a normal distribution chart and the frequency of the S&P returns, the kurtosis, which is a measure of peakiness, is 0. However, if you look at daily returns since 1990, you'll realize that over 70% of the time, the market tends to trade within plus or minus 1% every day. But you have these observations at minus 6%, plus 8%, minus 8% in a given day, and the kurtosis measure is over 9. So one of the things is the fat tails are more, I think, extreme when you look at the shorter the time period you're looking at, whether it's a day or a month, you'll see a much more evidence of fat tails. But if you tend to be a longer term investor and looking at annual returns, you actually see those fat tails actually over time disappearing because at some point the markets become rational and investors become rational. In terms of like the portfolios, one of the things we'll look at is there's beta to the market, the stock market. But the other thing of interest is to look at what are other, and not just the traditional factor bets, but as running an equity portfolio, do you have bets to credit, to interest rates, to the yield curve, to foreign currencies, to commodities? And kind of we built in-house models, just looking at daily returns and just looking at the stocks we owned and how, as a portfolio level, how correlated are they with some other factors, which may make you vulnerable to a fat tail if there's an event in the credits or internationally.